Then as we got the pre-acquisition profit and post-acquisition profit and their distribution in between parent company or cost of control and parent company cost of control and non-controlling interest according to the degree of control. Pre-acquisition profit is distributed according to degree of control 80% and 20%, and post-acquisition profit is also distributed according to degree of control. Degree of control control 80% 20%. Then we will got calculation of share cost of control and non-controlling interest. Then share of P company in S company means 80% has been degree of control. This share capital whatever is given, the 40,000 share capital, then it will taken of share capital is will be taken 40%, 80% of 40,000 is 32,000 plus share of parent company in post acquisition profit, sorry, pre acquisition profit. Only mind it, pre acquisition profit of parent company will be taken to calculation of cost of control. Post acquisition profit will not be taken to calculation of cost of control, because the post acquisition profit is after date of acquisition, so that it will be taken to reserve and surplus under the consolidated balance sheet, not only balance sheet, under the consolidated balance sheet. Then we deduct the investment by P company in S company, means investment wherever given, this here the investment is given, here the investment is given. Here the investment is given. Then after all we get that if investment, then we get the COC means cost of control. Cost of control we got the COC, the cost of control is 35,334. Then we deduct the investment from that, from the cost of control. It is the minus figure. As though it is minus figure, then investment is more than the actual cost of control, so that it is the goodwill for the parent company. And if investment is less than actual cost of control, then it will go to capital reserve under liability side. It will go to asset side of the balance sheet, as goodwill is the asset items. If investment is more than cost of control, then it is goodwill. If investment is less than cost of control, it is the liability for a liability, so that it will be taken to capital reserve, as capital reserve to liability side of balance sheet, as reserve is a liability item under balance sheet. Then we should calculate the non-controlling interest. Non-controlling interest, share of minority share in the minority share in the subsidiary company 80,000, as it is 32,000, it will be 80,000. Total is the 40,000 was the share capital. 80% of 40,000, 80% of 40,000 of will be the 32,000. Remaining is the remaining 8,000 will be the 20% is the 8,000. Then share of pre-acquisition profit, means whatever we have calculated here. Then post-acquisition profit, whatever we have calculated here. Then we got NCI, non-controlling interest. Then we will treat it in the balance sheet. One remaining point, that whenever we are doing the balance sheet, we will remember that asset and liability will be taken over. Means will be added by consolidated balance sheet. But investment in the parent company will not be taken over. Investment by parent company in subsidiary company will be not taken over. But then equity and reserve and also any item will not be taken up. Subsidiary company will not be taken over. Got that? Equity, share capital, reserve surplus means profit of that company of a subsidiary company will not be taken over, but parent company will be taken over. You know that investment in parent company, whatever the balance sheet. This is the consolidated balance sheet. Means parent company plus subsidiary company means CBS, consolidated balance sheet item. It is the non-current asset total. Non-current asset 1,40,000 is the non-current asset. Investment is not, will be not taken over. How much good? Then what was the asset item? Current asset. How much current asset? Here you see current asset is the 40,000 and 60,000. Line by line asset will be taken over. Means 1 lakh will be taken over. Then another item was there. We got that goodwill is the balance sheet item. Then goodwill will be taken over. Goodwill is 24,666. Then goodwill directly taken over to consolidated financial statement. Parent company and subsidiary company. It is the balance sheet. How much this is the 1 lakh to 2 lakhs? It is 1 lakhs. It is 40,000, 1 lakh 40,000, 2 lakh 40,000, 2 lakh 40,000. Like 40,000, then 2 lakh 64,666. It is the final item and balance of the asset side of consolidated balance sheet by adding the parent company asset side item and subsidiary company asset side item. Then we will go to liability side. Liability side whatever is given, equity share capital or share capital. Remind that equity share capital of a parent company will be taken over. Equity share capital of parent company is will only taken over, but subsidiary company will not taken over to consolidated balance sheet. This is consolidated balance sheet. Means that why it is not taken over? It is not taken over due to here the treatment has been done. Here the every treatment has been done in between them. Only here means only share capital will be taken of parent company, not subsidiary company. Every asset and liability will be mixed add up to consolidated balance sheet, but it will not, but share capital, reserve surplus and investment by share parent company will not taken over. reserve and surplus 20,000. 20,000. Here we got that, as we know that only parent company, pre-acquisition profit will be taken, but post-acquisition profit whatever we got, the 4,666 4,666 will not be taken to calculating cost of control, but it will be taken to to subsidiary company post acquisition of profit to consolidated balance sheet, but it is not taken to the cost of control. Means here the amount is given, add reserve and surplus 4 lakhs 6,000. Then NCI is also a balance sheet item. NCI is also a balance sheet item. So NCI is how much? NCI we got here 10,000. 10,000 will also taken NCI. Then non-current liabilities. Then a liability will be taken over. Add up line by line. Liability will be taken over. $30,000 plus 30,000, 60,000. Current liabilities 30,000 plus 20,000, 50,000. 20,000, 140,000, 140,000, 60,000, 2 lakhs, 2 lakhs, 40,000, 10,000, 20,000, 1 lakhs. Then we will this is the consolidated balance sheet item. These are the general balance sheet item. This is mix of that 1 lakh 20,000, 2 lakh 10 lakh 60,000, 60,000. You see that the balance sheet has been matched, means the our work is finished. In accounting, here every balance matching by balance sheet, the work has been finished and every procedure has been completed. Then we will check that how much consolidated balance sheet, line by line asset will mix up, except goodwill, except investment by subsidiary company, equity share capital, and reserve and surplus. But whatever will be taken new item beyond the balance sheet, goodwill or capital reserve. If investment is more, then it will be the goodwill. If investment is less, it is the capital reserve. Then the balance sheet item will be taken like that. We will test this. This is the asset side. How much liabilities side is incurring? 1,20,000. Our liability side and asset side has been matched. Pre-acquisition profit has been taken over. Our final work is complete. Asset side and liability side, we have what we have calculated, it is being matched. This is the consolidated balance sheet. And this is the general balance sheet, means without consolidation. Whatever IND as 110, IFRS 10, accounting standard as 21 is telling to consolidate the balance sheet. After consolidation, this become it is the form, it is the process to consolidate the balance sheet. 4 process: measurement of degree of control, measurement of date of acquisition, pre-acquisition profit and post-acquisition profit, treatment and sharing of profit according to the degree of control ratio. These are the general procedure to consolidate one balance sheet.